How are you today? I hope you have been having an excellent time as we go through the process of developing our knowledge, understanding, and expertise dealing with accounting. Yes, and so we welcome you once again, ladies and gentlemen, to our Kings and Queens accounting class. Oh yes, we have been looking at the various concepts within accounting, and today we're going to be focusing on company accounts. We have recently completed our look at non-profit organizations. We have looked at manufacturing account, partnership accounts. All these are lessons that have already been done, and once you have subscribed, you will be able to obtain all of these lessons that were produced. Of course, we have also looked at cash book, double entry system, income statement, balance sheet, the works. But now we are moving to look at accounts relating to companies. Yes, accounts relating to companies. And we looked at accounts relating to sole trading businesses. That is where the owner, yes, one individual is in control of that business, and all the profit or losses will be assigned to that individual. We have also looked at partnership accounting, where we have more than one owners to the business, partnership, and we have addressed that issue where these accounting concepts are concerned. But now we are going to be looking at company. Now, what is a company? It's really a more expansive size of ownership than the partnership business. While there is a limitation on the number of persons within a partnership business, companies tend to have an unlimited or greater number of persons to become part owners of that institution. So, and there is at least two main types of companies. We have the private companies, and we have the public companies. Private and public. Private limited and public limited. Okay? These are two types of companies. Yes? And there's a main difference between these two types of company is in relation to how they ascertain their capital. How do they get persons to become part owners? With the private limited company, yes, the members, or those who are organizing that company, can only obtain other owners we refer to as shareholders, yes, by private means. So it may be in relation to the private discussions with friends and family members to become a part of that company. Unlike the private limited company, the public limited company, however, is where now the part owners, or shareholders as we refer to them as, you can advertise it. They advertise it to the general population or the public, and anyone can become a part owner and be a part of a public limited company. And public limited company tend to be larger in size because of the reach that they have in soliciting new shareholders. Yes, and I speak of shareholders because in a company, the company subdivides its capital into small portions. Yes, small portions, and it is called shares. And these shares are valued, are given a value or a price. Right? The shares are priced. For example, one share may cost, let us say, $2. So anyone buying a share, yeah, they'll pay $2 for it. That's a price. So they divide the amount of capital that they are requiring to operate the company into small portion referred to as shares, and they put a price on each share and then offer it to individuals to buy to become part owners or shareholders. Now, the capital, there are the types of capital, yes? So in terms of, we have looked, in terms of capital, we know that they have what is known as authorized capital, and they have what is called issued capital, right? I have jumped ahead of myself in my objective, but work with me, please. So we're taking objective 2 and 3, and then we go back to objective 1. So the capital structure really is where they would, in what is a document refers to as the Memorandum of Association, yes, they are required to declare the maximum amount of capital that they will require to operate the company, among other things, among other clauses that they'll have to disclose, yes. And so in the structure of their capital outlay, they would indicate in the Memorandum of Association what is referred to as the authorized capital. All right, authorized capital really is referred to as the maximum amount of capital that they are expected to use to operate the business, maximum. So we have the authorized capital, right? And you have the issued share capital. Now, while authorized speaks to the maximum amount, the max, right? The issued speaks to the actual, right? Issued share capital has to do with of the total authorized share. When they offer it to the public, yes, the amount of persons who actually buy the shares and they allocate to the share, allocate those shares to these individuals, is referred to as the issued. The amount of persons who have taken up the shares and become shareholder, and that is what is referred to as the issued share capital. Now, there are many companies have situation where you have call-up capital. They ask you to pay a certain proportion of the amount that they're allocating. So if you are a shareholder and you are allotted capital of, let us say, $1,000 worth, and they say, all right, we're going to take 50% first. So they will call you up and ask you to pay $500. The $500 you pay is the first call. Is what they refer to as first call. Yeah, first call. Let me write that properly. Okay. Now, if you did not pay up at the time when they call, it may be what is called call in arrears, right? Call in arrears. It means that they have sent to you and asked you to pay up of the total that was allotted to you, total value allotted to you. They indicated that you should pay the 500 and you did not pay, so it is a call in arrear. That means they call for the money, but you did not pay at the time given, so you are owing, right? It's a call in arrear. So these are some concepts: first call, and call in arrears, etc. Call, second call, that is when they're asking, they have allocated or they have scheduled how they want the money from you. Right? They could say, all right, if our first call is going to be $500, second call is going to be $300, and our third call is going to be $200. So each time they call on you to pay, you would pay based on that. Okay? All right. Just wanted to share that information so at least you are aware. Let's move on. So we have what is called the authorized share capital and issued share capital. And this is what we're going to be in the process of accounting company accounts. You will be spending time treating with the authorized and the issued share capital. All right. Now, what is the benefit? What are those benefits of being a part of a public company or be a part of a company? What are the advantages of operating a company? One of which is that, let's look at the advantages, yes? And the first advantage we're indicating is that these companies are limited liability companies. Limited liability companies. That's an advantage. Why is it an advantage? Because you can, the concept of limited liability, the word limited, means there's a boundary to which you can go to collect from the shareholder. You cannot take no more than what they have invested in the business. In the event that something goes wrong in the company or the company goes bankrupt, you cannot ask for no, you cannot require of the shareholders to pay more than what they have invested. So it is limited to the amount. Their liability in the company is limited to the amount they have originally invested in buying the shares. Okay? So that's a positive. They won't lose any private resources in the event that something goes wrong. Number two, capital is, you can raise more capital, right? Opportunity to raise more capital. And you can do that easily, right? Raise more capital easily. By that we mean, especially with a public company, you simply put it out, right? And to the public, and they will buy. Advertise it and they will buy. Advertise it perhaps through a prospectus, all right? Or you may have more person become a part of it by when you have listed on what is referred to as the stock exchange, right? And so you can obtain capital that way. Number three, there's a thing with it, is that the shares, as I said before, you can buy and sell your shares easy on the what now? Stock exchange. Right? And this refers to mainly to public companies. All right? Does not apply to private companies, but public companies. You can buy and sell shares easily. Easily, you can buy and sell it on the stock exchange. All right? There's one other thing, that one of the advantage that we have with companies, and that it has a long-term viability. Long-term viability. Unlike a sole trader, if the owner dies, then there's a great possibility the business will die or come to an end. With partnership, though you have more persons, but if some persons died, you can replace. But even then, the stability of the partnership comes into question, because you may have to dissolve that first arrangement. Yes, you're going to take on new partners. You may have to have a dissolution of the partnership by dissolving, ending that first partnership arrangement to start a new one. But when you have a company, yes, the company, even if a few shareholders die, it will not affect the stability and the operation of the company. Hence, we refer to it as long-term viability. So I've indicated 4 advantages, yes, in relation to companies. I must move quickly now to look at disadvantages. Now, what are those disadvantages? One is in relation to decision making. Decision making can be a lengthy process. Decision making can be a lengthy process. What do I mean? Because the company is large, to move information from one level to the next, to the top, to get the decision, and for it to come back to you may take quite a while to get done. So that's a disadvantage. The larger the company, the more difficult it is to have certain decision be executed, because if you are a regular worker and a set of workers who have passed on information up the hierarchy to the directors, the board of directors, it may take some time for them to meet, to decide on the matter, to return the information to you. So the process may be, decision making may be a lengthy process. The other disadvantage with the companies is that you may lose personal contact. In other words, the larger the company, the less likely for there to be an intimate relationship or a closer relationship with employees and directors and so on. So that may have a more distant relationship, more professional and less personalized relationship with your workers or even your clients. So that you may lose personal contact in relation to the employees and companies. Now we're going to look at the third disadvantage that may arise out of a company, and that is, especially companies have to do what is to have to they have to declare their financial statement, yes, financial statements to the public. So they have to declare their financial statement to the public. So we're seeing that in relation to disadvantage, it is likely that we'll have a situation where decision making may be a lengthy process, take longer for decisions to be made. With companies, we may have a situation where we're losing personal contact, especially between employer and employees, right? Because the business is large, the general manager might not know quite a bit of the persons who are working in the institution. So personal contact is lost. Also, especially public companies, the law requires them to make a declaration of their financial position or their income statement, as well as their balance sheet must be declared to the public. So that is also, and that carries with it a number of stringent measures that has to be in place. It has to be audited accounts, all right, internal audit, external audit, etc., to submit publicly. All right, so these are what we refer to as some disadvantages in relation to the companies. All right, so we'd have looked at the whole matter, the fact that in a company, it is structured a certain way in terms of its capital. All right, you subdivide the capital is like a cake, and you slice it into cut the cake into small slices. Each slice represent a share, and the shares would be sold to the potential individuals who we call shareholders, and they become part owners of the business. They put a price to each of the shares. The capital is either authorized and also issued. Authorized share capital refers to the maximum amount of shares that you are permitted to use to finance a company, as against issued, which is the actual amount that was taken up, that was purchased by the shareholders, and those individuals become now shareholders of that part owners of that company. So it's actual capital, actual monies obtained to run the company. And we spoke a while ago about the advantages and disadvantages. I'm going to move finally to look at the appropriation. There's an account statement that must be prepared in relation to the companies called the appropriation account. Now the appropriation account, and I'm going to seek to share here now. The appropriation account starts with the current net profit. So our net profit that would have obtained from the income statement or the trading and profit and loss account, right? That current net profit, assuming, let us say that is $100,000. And the next activity, because the companies, by law, Companies Act, require the company to pay what is referred to as their tax, yes, corporation tax. They now will have to subtract that from their current net profit. So that we subtract here. Can be done here or down the bottom, but most times it's done right here. Let's take from the profit less the tax, yes, the taxation, and let us say the tax amount is 1,000, and that would have been 99,000 left. All right, and then we're going to be now include our retained profit. Retained profit represents the profit that is coming from the previous period, right? We would, let us say that the retained profit is $30,000. So we're going to add it. So it's 0, 0, 0, 9, and 312. So we add the retained profit to the amount after the taxation is taken out. Then we're going to now make some allocation in relation to a few items in the company. First of all, we're going to allocate monies to our reserve. All right, so we're going to list reserves. Now, there are two main types of reserves that I want to introduce to you at this time: capital reserve and revenue reserve. One, capital reserve, and second, revenue reserve. All right, and I think you need to be able to understand the concepts. You have to relate to them. Capital reserve are really a kind of reserve that are money set aside. First of all, reserves in general are really money set aside for a particular purpose. Yes, future purpose in the company. It's like a family, and the family wants to buy wants to buy something for the home, all right? Let us say they want to buy some more food products for the home, or fruits and so on, and they set aside some money to buy additional amount. Yes, that would be speaking to revenue reserve in terms of operation. But the capital reserve, they are setting aside money to buy a car, or to buy an additional car, to do some expansion to the house, right? That would refer to as capital reserve. So in relation to companies now, the companies set aside monies either to do increased production, deal with production, or in relation to getting new asset, or to do expansion, or to launch out into new branches, etc. So the capital reserve speaks to where you are now setting aside monies to deal with some projects, yes? Maybe to buy a new asset, yes? So you might have an asset replacement reserve. You may have a building reserve, because you intended to do some expansion in the building. So you set aside some money in relation to do building. So capital reserve are really to put aside, the company puts aside money, all right, or put up money for it to accumulate to be able to accomplish a particular goal in terms of assets, fixed assets, yes? Whether it be building, whether it be machines, getting new machines, etc. While revenue reserve now speaks to setting aside monies maybe for expansion in the operation, right? Buying more goods, more stocks, etc. All right, or variation of production. So they have revenue reserve. Now, these two reserves are important to the development of the business, and as well, salaries and so on would be looked at through your revenue reserve. So let's move on. So the reserve would be subtracted. So be it your general reserve, that you have that general reserve, all right, and an item, let us say it is $10,000, all right, and then you move from that now. There may be a situation where you have bought out a business. Yes, you bought a business, and so you are writing off what is referred to as goodwill. So we're going to write off goodwill. The goodwill that is written off, they may do that in a yearly process. So each year, in order to allocate it, it is not allocated all at once. You are gradually writing off the goodwill. And what is goodwill? Is real. First of all, it is an intangible asset, right? Goodwill is an intangible asset. However, it is the excess of the price, the actual price or value of the asset that you're buying. So if the asset value $10, right, and you were asked to pay $4, so plus $4, so you have paid $14,000. The actual value of the asset is $10. So the goodwill would be the difference between the actual value and the sale price. Yes, the sale price. Sorry. So the difference between the actual value what am I doing now? I'm sorry. ACT actual value. Yes, so the difference between sale price and actual value. And the difference would have been the goodwill. So businesses, no, they don't want to write it off all at once because the portion may be big. Write it off against your profit all at once. So they do it gradually. So we're writing off goodwill. Let us say it is $5,000. Now, people go and buy shares into companies because they want to benefit. So the companies return some of the profits to the shareholders in the form of what is referred to as dividends. Yes, dividends. So we are going to be sharing the money, right? So we're going to also have what is referred to as our preference shareholders and our ordinary shareholders. Now, allow me to talk about that now. The preference shareholders, the shares are divided into these two main types. The preference share and ordinary share. Now, preference shares are really those shareholders who are given first call on the profits of the company. All right. So they as the word preference means, you are getting before. You're getting before others. So when you buy preference share, you are paid from the profit first. Okay. Now there are two groupings or two types of preference shareholders. One is referred to as cumulative and non-cumulative. Now, the cumulative preference shareholder is where the individual will receive monies if the company cannot pay this year. So the cumulative means if the company owes the shareholder monies or dividend for last year, let us say, argument's sake, we have $100 that must be paid year one, and it was not paid in year two. Yes, in year two, the company is going to pay this 100 plus the 100 for that year. So they're going to, it's a cumulate, right? That is a cumulative preference share. That is where the company owes the shareholder and did not pay last year. That money that was owed last year will be carried over to this year and be paid. That's why it's referred to as cumulative share, preference share. Non-cumulative means if the company could not pay last year the dividend, they will not be required this year to pay the preference shareholder. It is not cumulative.